All right, let's talk about bond pricing. And I mean really talk about it. Forget the crazy formulas and textbook jargon for a minute. What we're going to do here is build a real gut-level intuition for how this market actually ticks. Ready? Let's get into it. Okay, let me throw a question at you right off the bat. Imagine there's a bond, right? And it promises to pay you 100 rupees every single year for the next 10 years. Plus, you get your money back at the very end. So what's it worth? How much would you pay for that promise today? Is it 1,000 rupees? A bit less? Maybe more? What do you think?
The answer? The only correct answer is, it depends. I know, that sounds like a cop-out, but trust me on this one. That simple little phrase, it depends. Well, it holds the key to understanding the entire massive global bond market. Seriously. So the obvious next question is, what does it depend on? And that right there is the core question. It's what bond valuation is all about.
Look, we all know what a bond is. At its heart, it's just a promise, right? A promise of future cash. You get these little payments, the coupons, and then the big lump sum at the end. But here's the catch, and it's a big one. You can't just add it all up. Nope. The real puzzle, the whole game, is figuring out what all that future money is worth right now, today. And this just nails it, doesn't it? 100 rupees today gets you a biryani. Awesome. But 100 rupees 10 years from now? Maybe half a chai. It's a funny way to put it, but it perfectly explains the time value of money. A rupee in your hand today is worth way more than a rupee you're promised years down the road.
Okay, so if future money is worth less, how do we figure out how much less? Well, that leads us right to the single most important tool in bond pricing. It's called discounting.
Discounting. It sounds kind of technical, but it's really just a simple idea. It's the process of taking some money you're promised in the future and figuring out its value today. That's it. It's the magic trick that turns a future promise into a concrete, present-day number.
So let's be super clear about this because it's a huge mental shift. Your first instinct is to just add up all the future payments, right? But you got to fight that instinct. You don't value bonds by adding. You value them by discounting. You take every single one of those future payments and poof, shrink it back to its value today.
Okay, so we're shrinking future cash flows, but what determines the size of the shrink ray? What's the thing that controls how much we discount that future money? Well, it all comes down to one massive, powerful force: interest rates. This is the iron law of the bond market. It's like a seesaw. On one side, you have interest rates, on the other, bond prices. When interest rates go up, bond prices go down, always. Why? Well, think about it. Let's say you have a bond paying 5%. Suddenly, the central bank raises rates and new bonds are being issued that pay 7%. Your 5% bond looks kind of sad now, doesn't it? So for anyone to even consider buying your old bond, its price has to drop to make the overall return competitive with the shiny new ones.
I love this analogy. Interest rates are like gravity for bonds. The higher the rates go, the stronger the gravitational pull, and the harder it pulls down on the prices of all those existing bonds out there. It's a force you just can't escape.
But here's the thing. This gravity doesn't affect all bonds equally. Some are way more sensitive than others. And rule number one for sensitivity is all about time, the maturity. The longer a bond has until it pays you back, the more its price is going to get tossed around by interest rate changes. Why? Because so many of its payments are way out in the future. And the further out you go, the more that discounting math really starts to bite. And here's a great way to think about it. A long-term bond is like a long-distance relationship. It's super sensitive to any little change that happens today because all the promises are so far off in the future. All right, on to rule number 2. This one's about the coupon, that regular payment you get. And here's the deal. The lower the coupon, the more sensitive the bond is to interest rate changes. It's because you're barely getting any cash back along the way. Almost all of the bond's value is locked up in that one big payment at the very, very end. So its present value is almost entirely at the mercy of that discount rate. This is a hilarious way to put it. A low coupon bond is basically saying, hey, just hang in there, not much happening today, but trust me, all our hopes and dreams are in the future. And because everything is pinned on that distant future payoff, its value today is super, super sensitive to any change in interest rates. Okay, theory's done. That's the how it works part. But now let's talk about how people in the market actually talk. How do traders, the people who do this all day, every day, think and speak? This is where we get into the lingo.
This is probably the biggest difference between how normal people think and how traders think. You and I might see a bond and talk about its price. Oh, it's trading at 98. A trader? Almost never. They talk in yield. They'll say the 10-year is at 7.15%. Why? Because yield is the great equalizer. It lets them compare thousands of completely different bonds on an apples-to-apples basis. It's all about the total return.
And this quote just perfectly captures the culture. Talking about bond prices on a trading floor really is like going to a crypto conference and asking, how much is that in rupees? You're not wrong, technically, but you're definitely not speaking the language. You'll stick out like a sore thumb. In the world of bonds, the language is yield.
Okay, here's another piece of trader slang you gotta know: on the run. It sounds complicated, but it's dead simple. The on-the-run bond is just the newest one. It's the most recently issued government bond for a certain time frame, like the new 10-year Treasury. And because it's the newest, it's the one everyone is trading. It's the benchmark. It's the one everyone watches to price everything else.
And what's the best way to remember this? Think of it like the new iPhone. The old one, the off-the-run bond, still works perfectly fine, but everybody wants the latest model. That's the on-the-run bond. There's so much demand for it that it's traded constantly. And that usually means it has a slightly higher price and a slightly lower yield than all the older versions.
Whew. Okay, we have covered a ton of ground here. Let's step back and just boil it all down to the absolute must-know takeaways.
All right, here's your cheat sheet. Number 1, a bond's price is not the sum of its payments, it's the present value of those payments. Number 2, the golden rule of the seesaw: when interest rates go up, bond prices go down. Every time. Number 3, what makes a bond extra sensitive? 2 things: a long time to maturity and a low coupon. Number 4, talk like a pro. Speak in yield, not price. And finally, number 5, the on-the-run bond, the newest issue, is the king. It's the benchmark for everything else.
And really, that's what this all boils down to. When you're looking at a bond's price, you're not just looking at a number. You're seeing the market's opinion on the value of time, the cost of risk, and the demand for liquidity, all wrapped up into one. It's so much more than just money. And now, you know how to start reading the story.